Hi everyone, welcome to Learning Fundamental Analysis. Investors, they are investing their money on stocks and they wait for a long time. The long time may be 1 year, 3 years, 5 years or more than 10 years. Then they will find whether they have got the expected earnings for their investment. So for investing, the selecting the stock is very important. For selecting the stock, they use a tool called Fundamental Analysis. By using the Fundamental Analysis, they select stocks, they invest their money, they wait, they can see whether they can get the expected earnings from their investment year to year. If it is going in their way, then they will continue. Otherwise, they will take a decision of changing based on the fundamental analysis at that point of time. So one of the two ratios mainly used in fundamental analysis for selecting the stock is current ratio. What is current ratio? Let us see that. The current ratio measures a company's ability to pay short-term obligations. That is, if a company is running, they have to pay the bill, they have to pay taxes to the government, they need to pay interest for the loans they have got, and they have to pay the EMI for long-term loans. All those things they should do for running their business, for which they have to pay the short-term obligations. So the current ratio is nothing but a ratio between current assets and current liabilities. What is current asset? The current assets are liquid assets that can be converted to cash within 1 year, within 12 months. That is, we can have cash or the money we should receive from our customers. Likewise, we can have the current asset. The current means within 12 years. This current asset is very important so that we can pay our obligations to run the business. So what are the current assets? It may be cash in hand, cash in bank, debtors they are getting loan from us, stock we may have invested in other company's stock, bills receivable, we have already sent our goods but we needed to get the money from the customers, short-term investments, bills, the bonds and any other things, short-term loans and advances that we have already paid to other people, prepaid expenses, we have already paid the expenses, income earned but not received. These are all some of the things that will be considered as current assets because these can be liquidated within 12 months. That's the reason it is called current assets. The next term is the current liabilities. What is current liabilities? It refers to the business financial obligations that are payable within a year. So these are all the current liabilities. Bank overdraft. We might have got overdraft from the bank for which we are paying the interest also. That is bank overdraft. Creditors. We get loan from some persons. Those are called creditors. Bills payable. The suppliers to the suppliers. We have bought some material, raw material or some others from the suppliers for which we need to pay the bills. Short-term debt. Advances and deposits received, outstanding expenses. These are all current liabilities. That means we have to obey these expenses within 12 months. Then these are all called current liabilities. It is our obligation to pay all these bills. The ratio between current assets and the current liability is called current ratio. It is very important because it is a good liquidity ratio. Is anything greater than 1. When we are talking about the value, anything greater than 1 is best for the current ratio. If it indicates that the company is in good financial health and is less likely to face financial hardships, that means the company is able to run their business smoothly with the current asset they have got to pay the current liabilities. The company may have crores of immovable assets, but they need current assets. Then only they can pay the bills and taxes and paying the labors, everything they can do. So it is very much important. They need current assets to run the business in a proper way. So this ratio should be more than 1. That is very important. Then what is the best value everyone is considered? That is different. That is based on the industry in which the company is. From industry to industry, the enough current ratio is different. If it is a real estate, they need more current assets. If some other companies, they don't need that much current assets. So the current ratio depends on the nature of the industry. So the next thing is, if the current ratio is less than 1, that means very low. Then the investors will find out why it is this much low. If the company with this current ratio, whether they can run the business or they can get some other money to pay the current liabilities, all those things they have to analyze. The next one is 1.5 to 3. It is called excellent because they have got enough current assets to pay the current liability. So it is considered a best one. But at the same time, greater than 3 is too high. It is not a best way to have more than 3 as the current ratio. Why? Because the management has more than enough assets, current assets. That is not good for the company. They have to invest in some other ways their excess current assets and earn money from that can be shared with the shareholders. So if the current ratio is more than some value, then we can consider we may consider the management efficiency is not that much with the other companies. So we need to find out the company management should find some ways to invest the extra assets to get more earnings, and that can be shared with the shareholders. So the current ratio tells you how financially strong a company is, but also how efficiently it is investing its assets. So if it is more than 3 in some other companies, then they should be able to invest in some other way and earn money. That is a way they can increase their profit, they can increase their earnings, and that will be good for the shareholders. Let us see how we can use our application to select the current ratio with other parameters also in our application. This is the application we can use to select a stock based on the current ratio. This is used for the large capital. The large capital we consider if the market capital is more than 20,000 crores, then those are considered a large capital for our definition. So here, if you are interested, the current ratio should be between 1.5 to 2, then we can select this. Then we can see the stocks which are satisfying these conditions, that is the current ratio is between 1.5 to 2. If you are interested, we can also use other parameters to filter the stocks for selection. So for example, if you are only interested in PE, that is 5 to 10, then we can select this one. Only Coal India is satisfying these two conditions, that is current ratio is 1.5 to 2 and the PE is 5.46 in the 5 to 10 range. So this is the way we can select the stock, and we can also in the right side we can also get additional information about the Coal India, that is what is the current ratio, what is the current ratio, quick ratio, zero debt, that is debt ratio, the DIA hold 22.52%, FFI hold is 6.73%, promoter hold is 66.13%. Likewise, we can also get some other additional information about the stock. Based on this, we can select the stock, or if you are not interested, we can use other parameters like here, or other, if we are so much okay with PE 10 to 30, then we can select that one likewise, and what are the shares are available, and if we are interested only any particular share, we can use that one Hero Motor Car. Likewise, we can select whatever the stocks that is appropriate for our requirement. Based on that, we can select the stock. Likewise, we can have this kind of application for medium capital and small capital. This is the application for medium capital. Medium capital means the market capital is between 5,000 crores to 20,000 crores. Like in the large capital, here also in the medium capital also we can use any kind of combination, quick ratio, everything, and based on that we can select the less than 5 like this. We can select the stock and we can find further information about the stock, and based on the information we can be, if we are satisfied, then we can select for our investment. This is the application for small capital. Here the market capital is between 2,000 crores and 5,000 crores. I am considering only the stocks that have market capital more than 2,000 crores for convenience. Here also we can use proper combination of the parameters for our selection, and the current ratio, and anything we know, the ROCE. Likewise we can use, and we can select the appropriate stock for our consideration, whether we are able to invest in this stock or not. We can use the information and select the stock. Thank you for listening this video. We will meet in another one video learning another one topic of fundamental analysis. Thank you.